Well, thanks a lot for watching. We are here to talk about SEBI's virtual museum and of course the history behind a lot of products. And joining me now is Mr. G. Chandrasekhar. He is the member of the Commodity Derivatives Advisory Committee. Of course, he's a veteran in this space. Mr. Chandrasekhar, thanks a lot for joining us. We were just speaking that how this asset class has been there since ages. I mean, commodity derivatives have been in existence since 1947. I'm so glad that SEBI is doing this because, it will give a chance to the younger generation to learn more about this asset class. But you tell us, in your long association with, commodities, what do you see as the way forward?
Yes, it's like this. Before we get into commodity derivatives and the way forward, let me talk about what commodities are. Okay, commodities are goods with economic value. Number one, commodities do not have a standard definition, but we need to understand commodities from their characteristic features. And what are these characteristic features? One, they are products of the earth. Whether it is energy product, whether it is metals or agriculture, they are all products of the earth. Number one. Number two, they are produced in bulk, they are traded in bulk, and they are often raw material for further processing. And for these are the characteristic features of commodities, and that's the first part. The second part actually is that there are actually two markets. One is the physical market, cash market, or the spot market. The cash market or the spot market in commodities, again, whether it is energy products, agriculture, metals, is impacted by a host of factors. For example, weather conditions will impact agriculture, okay? And similarly, production of energy products or metals will be driven by several other factors. Therefore, when there are changes in the market drivers like demand or supply or weather conditions, prices will fluctuate. And therefore, those in the physical market face price risk because of price fluctuation, and particularly those market participants who trade for forward positions, they will definitely face a price risk.
Okay.
For commodity derivatives come in there as a price risk management tool, and commodity derivatives are the second part. There are two markets, as I said. The first market is a cash market. The second market is a derivatives market.
Okay.
The derivatives market.
Let me interrupt you here because just for an understanding, right? For someone who's perhaps never gotten into commodity derivatives, how liquid is it? How volatile is it? And since it originates way back in 1947, how has it evolved over the years?
Oh yes, that's a very, very interesting question. I'm happy to answer because, well, for almost 40 years or so, I've lived through these times. Okay, all right. India had a thriving commodity futures market until the 60s, mid 60s, 1960s. Obviously, you were not born then. Okay, and we had a very thriving derivatives market, futures market for gold, silver, cotton, and several other commodities, oil seeds, for example. But sometime in the early 60s, problems started to catch up. For example, we had war, we had drought and several other natural calamities which led to inflation, and the then government had a socialistic bent of mind. They did not trust the private traders, and therefore by mid 1960s, futures trading in commodities was banned by the government of India.
Okay.
And after that, for almost 66, 76, 86, 90, almost 30 years, nothing much actually happened. But in 1991, we had the economic liberalization, as a result of which our economic growth started to pick up. We had trade liberalization. We also had investment liberalization. We started to attract a lot of FDI. Therefore, through the trade route and the investment route, Indian economy slowly started to integrate with the global economy. And when you integrate with the global economy, not only the domestic market drivers, but also the international market drivers will start impacting your market. And then therefore, that created greater price volatility in the Indian market. Therefore, the market participants needed a tool to manage that price risk. And commodity derivatives are that tool, a scientific tool, time tested tool that allows value chain participants to manage or mitigate the price risk that arises out of fluctuations in commodity prices.
So where we are standing today, right, there's a lot that has changed over the last say 10, 20 years in our markets. We are now a significant importer of gold, we are an exporter of rice. So a lot of the agri market has also changed in that sense.
Yes.
How do you read into that? And based on these fluctuations, based on what's happening today, how does an average person, an average commodity trader approach it?
Right, absolutely. Let me briefly mention the history. 1995 was it, or 96? We were at the peak of our economic growth that time, post liberalization. In 91 we had liberalization, in 95, 96 our growth rates picked up. That is a time the World Bank and the UNCTAD came to the government of India with a suggestion that the ban on commodity futures trading must be lifted because the value chain participants here needed a scientific tool to hedge their price risk. And that is the time there was a consensus within the policy making circles that yes, the ban on futures trading that was imposed 30 years earlier is now outliving its utility. Therefore, we need to review that ban and restart the futures trading. For I have been a part of the journey from that time, 96, 97 onwards. 97, I was invited by the Forward Markets Commission, which is the then regulator for the commodity derivatives market, to be a coordinator for an international curtain raiser, a seminar that was held in Vigyan Bhavan in Delhi, where all policymakers and value chain participants and international institutions came, and I was a speaker. I also wrote a report for the government of India. 1 year later, in Bombay at the World Trade Center, I recall very well, we had a follow-up seminar with again a lot of global participants on structured financing and warehouse receipt system. And again, I wrote a report. I was a speaker. I wrote a report for the government of India on structured financing and warehouse receipt system. Today's Warehousing Development and Regulation Act, my report in 98 was a precursor to this act. Therefore, that's the kind of development. In 2000, allow me to complete. 2000, the government of India came up with a new policy. Those days, we had about 24 regional commodity exchanges trading one commodity or maybe a group of commodities. In 2000, the government of India said we need national exchanges rather than regional exchanges, and these national exchanges have to be demutualized, well capitalized. They must use technology and have an electronic trading platform, and that is how we had
changed.
MCX, we had NCDEX and NMCE, which were established in 2001, 2002.
And MCX and NCDEX have picked up in such a big way now. The volumes have gone up tremendously. The liquidity has improved. But what are the risk factors associated with all of this?
Yes.
And what are the different products that one can be looking at? Because I mean, this whole exercise that SEBI is doing as well with this virtual museum is educational, right? To teach people how to approach these products. So what would your advice be?
Therefore, the journey of MCX and NCDEX. NMCE, of course, closed down recently. That's another story altogether. But MCX and NCDEX are doing reasonably well. MCX has picked up extraordinarily in terms of volumes in gold, silver, etc. But remember, the original intention in 2000, 2001, 2, when these national exchanges were set up, was the policymakers believed these exchanges must facilitate Indian agriculture and Indian farmers and Indian growers to discover forward prices, which will send out a signal to them about cropping pattern, etc., etc. But I'm not sure if that purpose has been served. 20 years down the line, my own sense is that that original purpose of helping agriculture and farmers discover forward prices has not been fulfilled to any significant extent. This is something we need to accept. But at the same time, because of our economic growth, our import of energy products, our import of a lot of metals including gold and silver, and our consumption of base metals and industrial metals like iron ore and silver, iron ore and steel, our market participants are also facing price risk, and therefore now the focus of the exchanges has become increasingly on non-agriculture commodities.
Yes.
And agriculture commodities in recent times, in the last few years, have also faced a huge amount of policy risk, primarily suspension of contracts, etc. Whether it is right, wrong, we are not on that.
Yeah.
But there are risks relating to agriculture commodities, which the market participants, in my view, have now developed a certain reservation about trading in agriculture commodities, because there's no guarantee that these contracts are going to continue.
So we'll talk about that as well, agricultural commodities, all the risks over there. But in non-agri commodities, there's plenty of interest right now. You talked about energy, about gold as well. I think gold trading has picked up in a big way in the last 5 or 6 years, especially with the way gold prices are also moving,
Yes,
right?
right.
So for non-agri commodities, what do you see as the future? And what is the kind of opportunity? What is the kind of size that you see in this market?
Extraordinary opportunity for non-agriculture commodities. Even in agriculture, there are opportunities, but for non-agri, extraordinary opportunities, primarily because, as an economist, I am convinced India's economic growth over the next 25 to 30 years will be substantially commodity intensive. Whether it is infrastructure development, whether it is energy transition, whether it is urbanization, all these are going to make India a large producer of commodities, processor of commodities, consumer of commodities, importer of commodities, or an exporter of commodities. So our economic growth is going to be driven by commodity markets, and our growth is going to be driven by commodity consumption, which is very clear. In the next 25 years, I can see that happening, and therefore, because commodity markets are going to drive India's economic growth, we need scientific, well-tested risk management tools, because prices will fluctuate. That is in the very nature of commodities, and as we integrate with the global market, as the economy integrates with the global market, as our commodity markets integrates with the global commodities market, there will be volatility, there will be price fluctuation. We saw how, for example, just a year ago, the Ukraine
crisis,
Russia's conflict with Ukraine, how it completely spooked all the commodity markets.
Especially gas prices globally, right? And I'm glad you brought that point out, Mr. Chandrasekhar, because a lot of the markets in India have evolved also taking some cues from global participants.
Absolutely.
In that context, what are the gaps that you think lie currently in the commodity derivative space? And what do you think we can learn from our global counterparts, whether it is Asia, Southeast Asia, China, etc.?
Right. There are 2 or 3 areas that need attention. Number one, the hedger participation in our commodity markets is rather limited, and I feel sorry about it. This, again, I'm being very blunt, this reflects the inadequacy of marketing efforts by the exchanges. We need to draw in more and more hedgers to manage their price risk. They need to come to the exchange platform. We do in this country a very large number of events around the year, but what is the effect? Is there a proper communication? What is the effectiveness of the communication to the market participants and to the stakeholders and to the potential hedgers? I think that's inadequate. That's an area that needs very close attention, both by the regulator and by the exchanges. I'm very, very clear about that.
Okay, that's one.
This is one, and I'm happy to help in these areas because I've done some work in these areas. Number 2 is very, very clear that that we need to pay, in case of agriculture commodities, we need to pay from a policy perspective, lot more attention to reforming the physical market of agriculture.
Okay.
Because agriculture is facing and will continue to face new challenges. Climate change is a big challenge.
Absolutely,
Land constraints,
absolutely.
water shortage, all these are going to impact Indian agriculture. And
Labor issues,
and
yeah.
therefore we need, yes, labor costs are going up, and therefore mechanization is a way forward. Therefore, the point I'm making is the physical markets need a lot of attention. And pardon my saying, and again I'm being blunt, I think the physical market, the cash market is not getting that kind of attention that it deserves. It needs to be reformed.
You
And
know,
once
once
we
again,
have-
I have a question here, and how this could help, right? The only way these things have changed in the past is when large investments come through. You need money for everything.
Yes.
In that context, do you think the Indian ecosystem, the commodity derivatives or commodity ecosystem in general, has enough in it for global investments to come through?
No, it's like this. When you talk of global investors to come in, if you are talking about their investment in the physical infrastructure, physical market, absolutely fine. I have no problem at all. That is what we need. That's the kind of investment we need. But if you're talking about global investors coming into the derivatives market as a financial investor to benefit from the fluctuations in prices, then it's another conversation altogether. We need global market participants, there is no doubt at all. But I would like to see increasing amounts of foreign direct investment go into
The physical
creation
market.
of physical assets in our country.
Yes.
And once you have enough FDI to create physical assets, reform the cash market and the spot market, there is no problem in getting foreign money, foreign investors come and play come and participate in your derivatives market. I don't see that as a problem. But when you have an unreformed cash market, a weak, fragile cash market, and then you allow large amounts of money and those investors use technology, for example, algo trading. There's nothing wrong in algo trading. I'm not against it, but it's an unequal playground that it creates, and that can potentially distort the market and send out wrong signals. And therefore, cash market reform the cash market, strengthen the cash market, make it more robust, make it more transparent. I'm sure a lot of money will come in from outside.
Okay, what else? You were telling me about some more challenges that this market is facing that can or should be addressed.
Oh yes, of course. One is education, awareness and training of all the market participants.
Which SEBI is doing very rightfully and very well, right? By educating whoever they think is the target audience through this virtual museum.
No, this virtual museum is, in my view, for the next generation.
Okay.
They have to learn.
Yes.
They have to learn the history. We can't forget history because history tends to repeat itself. And therefore, we need to learn from what happened in the last 30, 40, 50 years. In the
So when you talk about education, what do you refer to?
I'm talking about creating greater awareness about the need for risk management amongst value chain participants,
Yes.
particularly in the agriculture space.
Okay.
There are numerous hundreds of thousands of small processing plants in the agriculture ecosystem, whether it is a rice mill or wheat flour mill or dal mill or a solvent extraction plant or a oil seed crushing plant, edible oil refinery or sugar mills, cotton ginning and pressing plants, cotton spinning mill. I mean, there are thousands of them. How many of them are participating in this market? Not many, I'm sorry to say. And over the last 20 years, we have done so many events and still we have not been able to attract enough participants. There is something lacking, something fundamentally wrong, not with the market participants. Those in the cash market still continue to face price risk. We need to go and convince them that this market is good for them, that awareness, education, training is what is important, and that needs a certain amount of commitment and certain amount of passion in interacting with them.
So we have spoken a lot about the challenges, right? Let's flip it over and talk about the positives, because ever since SEBI has taken over the ownership of commodity derivatives, a lot has changed, a lot of ownership, a lot of awareness has picked up. But what do you think the salient features have been?
For long years. Anyway, for the CDAC has been very proactive. We set out in 2016, 17 was it? Yes, 16. We set for ourselves a certain roadmap that over the next 5-6 years what we need to do, and we have achieved very substantially all of that. What were those? For example, allowing options trading. Now options trading is now allowed, both options on futures and options in goods. Index trading is allowed. Then you have mutual funds, new market participants. Mutual funds are allowed. AIF category 3, alternate investment funds, category 3 is allowed. PMS is allowed, portfolio management service is allowed. Okay, and therefore these are big changes that SEBI has brought about to deepen and widen the market. But we cannot stop here. This is an ongoing process. We need to be looking at expanding the number of market participants here, and therefore, and then the untapped potential hedgers are far too many in this country. We need to bring all of them into this marketplace. That is what is going to, in my view, lead to genuine price discovery. Okay. We have price discovery today, but is that a genuine price discovery? I don't know. I don't want to comment on it. But when we have more liquidity because of greater participation of a more number of hedgers, I think the genuineness of the liquidity of price discovery will certainly be far elevated.
So this is your observation only for the commodity market? So in general, you're saying that there is overall, an improvement in across asset classes ever since SEBI has sort of taken ownership?
No, SEBI is a very focused organization. SEBI is an autonomous body, unlike the FMC, Forward Markets Commission, which was a department of the Ministry of Civil Supplies, with due respect. So SEBI and SEBI's leadership, and I have known is very progressive, which is very important, and therefore I have every hope that with this kind of leadership that SEBI has, the commodity markets will flourish and become robust. But let me add something here.
Sure.
I don't know whether I should say it in public, but let me be bold enough to say.
You can be candid.
Yes, candid. No. Recently, at SEBI's request, I have written a roadmap for SEBI for commodity derivatives going to 2025 and 2030.
Lovely.
I have made a series of recommendations, and all this is under SEBI's consideration. I had a meeting with SEBI's chairperson 4 months ago. I've explained to her what are my thoughts and what should be done to deepen and widen the commodity derivatives market, and I have every hope that
I'm so glad to hear that, and I'm so glad to know that there is a there is a structured and a focused approach to kind of widen the commodity derivatives market. Before we end, you want to leave us with a couple of salient features of what that document involves, in the sense, I mean, of course, not trying to hear all about it, but what do you think are the top 2 or 3 things that commodity derivatives as an asset class needs to be sort of, to see growth?
Correct. 2 or 3 things. One is again education, awareness and training amongst potential hedgers. You have a certain number of you have a very large number of physical market participants, but a very small number of participants in the derivatives market. So that needs to expand, and therefore we need to reach out to those potential hedgers out there in the economy. So that awareness, education has to be in a very structured way, and this has to be strengthened. If need be, more funds will have to be allocated for that. The second one is a policy challenge over which SEBI may have very limited control. For example, the Government of India suspends the futures derivatives contract of agriculture commodity. We have seen it in the last 2 years. So what can SEBI do? SEBI will have very limited role in this, but I have recommended, and it has been in principle accepted, that there is a strong need for setting up a commercial intelligence and research desk within SEBI to track commodity markets. Look at the global market dynamics, look at global market drivers, look at domestic market dynamics and drivers, have a view of the emerging situation. Most people know what has happened until last evening, but they have no clue what is likely to happen next week, next month, next season.
Sure.
We need to get that view, emerging situation, and once we get that emerging situation, and there are techniques available of price forecasting, crop forecasting, etc. Once we use all of those, then SEBI will have a view of the emerging price trends. Then SEBI can talk to the government of India and say, in our view, this is likely to happen. Crude oil prices are likely to rise, or whatever else. Copper prices are going to fall, or cotton prices will spike, whatever. I think that kind of advice, then the government will take a call. What should be done? Therefore, today there is a lack, with due respect, I am saying there is a lack of commercial intelligence, market intelligence relating to commodities within the government of India, and obviously within SEBI. I would have strongly pitched for setting up this kind of a research cell, commercial intelligence. So this is the second one. So education,
a data
research,
hub, a research hub,
and advising the government of India. We need to be. You take gold, for example. We are world's largest importers of gold, very large importers of gold. But for at least 20 years, we have been talking about India is a price taker, but we should become a price setter. What have we done to become a price setter? We have done nothing. We are just importing gold and we are happy. We can become a price setter.
Yeah.
So 2 years ago, I wrote a paper on what should Government of India do, what should RBI do, what should SEBI do, so that India becomes a price setter in gold. It's not going to happen overnight. It's a process. Therefore, there are 5 or 6 steps which I have enumerated that we must look at. So we need to do
a lot.
We need to work towards it.
Towards
so
that.
there are too many thoughts which I put in there. Anyway, I'm happy I'm a part of it. This is quite exciting. But I must issue a disclaimer. I am not a trader. I don't hold any trading position.
Sure, of course. We put that disclaimer.
I'm a student of this market.
And so
I enjoy being a student. I learn all the time.
Yeah.
And I do price outlook. I do market outlook, forecasting, crop production numbers, etc.
Sure.
All that I enjoy doing it. And I must say, with a little bit of immodesty, my numbers are very close to reality.
Okay, anyway. All right. Well, we'll leave it at that. Thank you so much for joining us. And of course, we are all students here. We're all here to learn. And that is the purpose of SEBI's virtual museum. Thank you so much. A lot of work has been done already, but I understand that lots more is left to be done. Thanks.
Thank you very much, Sonia. Pleasure talking to you. God bless. Take care.